Hi everyone, welcome to Managerial Accounting. This is a Cengage textbook and we're dealing with chapter 6 today, Cost, Volume, Profit Analysis. So here are just the various objectives we're going to cover today, but we're going to look at behavior of costs. Cost behavior is the manner in which costs can change based on how activities change. So cost behavior depends on making sure we look at the activities that may cause a cost to change. We call those activities activity bases or activity drivers. Specifying the range of activity over which the changes in the cost are affected are what we term the relevant range. So we need to be realistic when we're talking about activities changing. They've got to be within a specific range that we're discussing. Cost, we're going to classify as variable, fixed, or mixed. Now, variable costs are going to vary in relationship to changes in the activity base. When activity base would be units produced, then direct materials and direct labor and costs, those costs are normally classified as variable costs. If Jason Sound Inc. produces stereo systems for a certain model, and if we know that the relevant range of him producing these systems is given 5,000 to 30,000 units, we see that the direct materials that go into those units are at a set amount per unit. So the direct material cost per unit remains the same regardless of changes in the activity base. Total cost changes in proportion to changes in the activity base. So here, the cost per unit of direct materials is the same. Based on the number of units produced, those materials can change, but they're based on the units produced. So if we produce 1,000 units, they're going to be $10 per 1,000 units, times 1,000 units. If they're 5,000 units, they're going to be $10 times 5,000 units. So this is a cost that varies based on how many units are being produced. This slide right here shows how the variable cost of the direct materials for the model JS12 behave in total and on a per unit basis as the production changes. For Jason Sound, units produced is the activity base. For model JS12, the cost per unit is $10. For model JS12, the direct material cost for 10,000 units is $100,000, is twice the direct material cost for just 5,000 units. Examples of variable costs and their related activity bases for various types of businesses are shown here. So you see that with the university, the cost of salaries is going to be based on the number of classes that are needed. For passenger airline, fuel is going to be based on the number of miles flown. Direct materials, as we looked at in the previous example, are going to be based on the number of units produced. Hospital with nurses' wages are going to be based on how many patients are there. Or with a hotel and housekeeping wages, it's going to be based on how many guests. Same with a bank. The teller wages are going to be based on the number of transactions that the tellers provide. As you see here, fixed costs have various characteristics. Cost per unit decreases as the activity level increases and increases as the activity level decreases. For Jane Sovisi's salary, the cost per unit decreased from $1.50 for 50,000 bottles produced to 25 cents for 300,000 bottles produced. The total cost remains the same regardless of changes in the activity base. Jane Sovisi's salary of $75,000 remained the same regardless of whether 50,000 bottles or 300,000 bottles were produced. This slide here shows how Jane Sovisi's salary, which is a fixed cost, behaves in total and on a per unit basis as the production changes. Some examples of fixed cost and their related activity base are shown here. So a university, the building, it's a fixed cost because the number of students, the more students, then that fixed cost will go down per student. But it's a fixed cost given a relevant range, no matter how many students are at the school. The airline, for an airline, the airplane that's being used, that airplane, granted, there will be maintenance costs per se, but the depreciation on that airplane is going to be the same no matter how many miles are being flown. Or with the plant manager's salary in a manufacturing, if 1,000 units are produced or 100,000 units within the relevant range, that plant manager's salary is going to remain the same. So per units produced, it will go down, but it's fixed no matter what. Same with hospital insurance or property taxes of a hotel, or even the branch manager's salary. How many customer accounts are there? The branch manager's salary will remain the same. Now, mixed costs are costs that have characteristics of both variable and fixed. They're sometimes called semi-variable or semi-fixed costs. So Simpson Inc. manufactures sails using rented machinery with certain rental charges. So we've got a $15,000 rental charge, and then we have an additional $1 for each hour used in excess of 10,000 hours. So based on various hours used within a relevant range, we could see how the costs can change. So if we've got 8,000 hours used, the cost of 15,000 rental charge is all we've got. Where if we've got 12,000 hours, we're going to have an increase of 17,000. 20,000 hours used would be a rental charge of 25,000, and 40,000 hours used, we would have a higher cost. Here, this shows you how mixed costs play out within a relevant range. So with that rental charge, there is a certain base cost, and then as the hours increase, that cost will also increase. The high-low method is a cost estimation method that separates mixed costs into fixed and variable components. So this uses the highest and the lowest activity levels and their related costs to then estimate the variable cost per unit and then the fixed cost. So assume this equipment maintenance department of Casson incurred the following costs. In June, There were 1,000 units produced with a $45,550 cost. In July, 1,500 units were produced at a cost of $52,000. In August, 2,100 units were produced at a cost of $61,500. September, we had 1,800 units produced at a cost of $57,500. And then October, we had 750 units produced at a cost of $41,250. So the number of units produced is our base, and the relevant range is the units produced between June and October. So here, the highest level of 2,100 units cost $61,500. The lowest level, 750 units, cost $41,250. That difference of 1,350 units had a difference in cost of $20,250. So we can take that variable portion. We can take the fixed portion of the $41,250, and then we can come up with a variable cost per unit. So the fixed cost are going to be total cost minus our variable cost per unit times our units produced. The fixed cost is going to be similar if it's the highest or the lowest level of production. So you see here, as we look at this example, our fixed costs are going to show at $30,000. We can take the variable cost per unit and the fixed cost, and the total equipment maintenance costs can be computed based on various levels of production. So we take our $15 times the units produced plus our $30,000 to come up with our high-low method here. Mixed costs contain a fixed cost component that's incurred even if nothing's produced. For analysis, the fixed and variable cost components of mixed cost are separated using this high-low method. Now, this slide provides some examples of variable, fixed, and mixed costs for the activity base of units produced. Let's look at a question for you here. This question shows, which of the following costs remain the same regardless of activity levels within the relevant range? Wouldn't it be the total fixed cost and unit variable cost? Cost behavior is going to vary based on changing activity levels. Total variable cost and unit fixed cost will either increase or decrease, but the total fixed cost and unit variable cost will remain the same regardless of activity levels within the relevant range. So here we've got some examples of costs, and we're going to classify these various costs. So as you see in this slide, we've got a list of various costs incurred in producing replacement automobile parts. With respect to the production and sale of these auto parts, classify each cost as either variable, fixed, or mixed. So oil used in manufacturing equipment would be variable. Plastic is going to be variable. Property taxes are going to be fixed. The salary of a plant manager will also be fixed, but the cost of labor for hourly workers are going to be variable. Packaging is variable. Factory cleaning costs, again within a relevant range, are fixed. Metal will be variable. The rent on the warehouse, now in this case, it's mixed because there's a $10,000 per month flat fee plus $25 per square foot of storage used. Now this one also is going to be mixed. Insurance premiums we've got a fixed, but then we have 1 cent on each dollar of property over 1.2 million. We know our straight line depreciation is fixed. It would be variable, the hourly wages of machine operators. The electricity costs are variable. The computer chips that we purchase from vendors are going to be variable. And our pension cost will also be variable. Okay, now we're going to look at an exercise here to see, we've got various graphs here. And we've got the various graphs that provide us with information. So you see with graph 2, cost graph 2, there is a certain amount no matter what the production is. We see a cost graph 3, as production increases, the cost increases. And what we need to do is look at each of these graphs. For each of the following costs, identify the cost graph that would best illustrate its cost behavior as the number of units produced increases. So with direct material cost, you see as the number of units increase, our cost will increase. So that would be the total cost increases. That would be graph 3. The electricity cost of $1,000 per month plus 10 cents per kilowatt hour. You see, that would be graph 4. That's like a mixed cost. The per unit cost of straight line depreciation on factory equipment. That straight line depreciation is a fixed cost. So the fixed cost is set, but as the units are produced, that fixed cost decreases per units produced. The salary of the quality control supervisor, that would be graph 2. It's going to be there no matter what. And the per unit direct labor costs would also be graph 2. Here, we're going to look at some various activity bases. And we're going to see, for a major university, match each cost in the following table with the activity base most appropriate to it. And some of these activity bases can be used more than once. Some don't even have to be used at all. So if we take a look at these, we'll see here that we've got financial aid office salaries. Our base would be the number of financial aid applications. Office supplies would be number of students. Instructor salaries, student credit hours. Housing, personnel wages, those living on campus. Employee wages for maintaining student records would be number of enrolled students. And then the admission office salaries would be the number of enrollment applications. Here again, as we deal with activity bases, from the following list of activity bases for an automobile dealership, select the base that would be most appropriate for each of these costs. The preparation cost for each car received, the salesperson commission, the administrative costs for ordering cars. So as you see here, we've got number of cars sold. For the preparation costs for cleaning, oil, and gas for each car received, we would look at that as the number of cars received would be our good activity base. For salesperson's commission, we would show number of cars sold. It's not really going to be the dollar amount of cars sold. We would have that as the number of cars sold because that's where we've got our time in. And then for administrative costs for ordering cars, it would be based on the number of cars ordered. Intuit develops and sells software for personal financial, QuickBooks, TurboTax. Classify each of the following costs and expenses for this company as variable or fixed to the number of units produced and those sold. So we will look to see if they're variable or fixed to the number of units produced and sold. So we've got packaging costs would be variable. Also commissions for sales would be variable. The property taxes on the general offices are fixed. Shipping expenses are variable. Our depreciation, straight line on computer, fixed. President's salary is fixed. And the salary of software developers would be fixed because the developers aren't based on what's being sold. They're developing based on new products coming out in the future. Human resources personnel is fixed. Telephone order assistance would be variable, as would be cost of providing online support and our user guides. Now, cost, volume, profit analysis is a tool that's used to look at relationships among selling prices, sales, and production, volume, costs, expenses, and profits. And it helps managers make decisions. The ways cost, volume, profit can be used can help look at effects of changes in selling prices, changes in costs on profits, looking at the effects of changes in volume on profits, setting selling prices, selecting the mix of products to sell, and then choosing among marketing strategies. The contribution margin is the excess of sales over our variable costs. That contribution margin is the amount of revenue that then is available to help cover the fixed costs, and then after the fixed costs to ultimately earn a profit. So if we look at Lambert, we've got sales of 50,000 units at $20 a unit. And we've got our variable cost and our fixed cost. So you see here the contribution margin would be our sales less our variable costs give us our contribution margin. Once we've covered our fixed costs, everything else on top is profit, operating income. Contribution margin can be looked at as a percent. If we know that we've got a contribution margin ratio, we can look and see if the contribution margin at Lambert is 40%, and we know the ratio then is 400,000 divided a million is 40%. We then can look at various strategies. As we're going to see coming up here in a slide, that when Lambert earned 100,000 of operating income, then, here, let me see where that went. Here. This is where it showed the 100,000 of operating income on sales of $1 million. This shows how Lambert prepared that contribution margin. The 400,000 covers the fixed cost of 300,000 and then earns operating profit of 100,000. Once those fixed costs are covered, any additional contribution margin then increases operating income. So you see here, let's assume that sales increased 80,000, 4,000 units times $20. Lambert's operating income will increase by 32,000, from 100,000 to 132,000. Changes in operating income will equal changes in the sales dollars times that contribution margin ratio. So since sales went up 80,000, If we take our contribution margin ratio of 40%, we know the operating income then increased $32,000. The unit contribution margin gets computed by sales price per unit minus the variable cost per unit. So if their selling price is $20 and the variable cost is $12, then the unit contribution margin is $8 per unit to apply to fixed costs. We can say the unit contribution is the sales price minus the variable cost. When a change in sales volume gets measured in units, the unit contribution margin can be used to compute the related change in operating income. So if we have a change in operating income of $15,000, we can take the number of sales units times that contribution margin to see how much the operating income changed. Here, if we sell an additional 15,000 units, that'll increase Lambert's operating income by 120,000. It'll go from 100,000 of operating income up to 220. Lambert could spend up to 120,000 for special advertising or other product promotions to help increase sales by 15,000 units and still increase income by 100,000. So that 220,000 increase in sales minus that 120,000 cost of special advertising is how we show this here. So guys, contribution margin ratio measures the percent of each sales dollar able to cover fixed costs and then to provide operating income. It's also useful in looking at strategies. If you think of a local supermarket or grocery store that you've shopped at, consider the location within the store of certain items like milk and bread. If you look at their location and assumed unit contribution margins, do you think these items have a high or low contribution margin ratio versus specialty items? And what would you think about the placement of staples within the store as well as other items within a typical layout of a grocery store? Usually, we don't have milk right when we run into the store, do we? They're usually way in the back of the store because they do not have a real high contribution margin. We don't know them, but I'm assuming they've got to have a lot of volume in sales to cover whatever those costs are. They're not bought impulsively like other items. Other products that rely more heavily on impulse shopping would want to be put closer to the front of the store. So the mathematical approach to this cost volume profit analysis uses equations to determine break-even in sales, and then once we have a break-even, what sales are needed for profit. The break-even point is the level of operations at which a company's revenues and expenses are equal. We can show break-even sales is going to equal our fixed cost divided by that unit contribution margin. Remember, revenues minus our cost are going to be our break-even. So with Baker, let's assume we have fixed cost of $90,000. We have selling costs per unit of 25. Our variable cost is 15, and our contribution margin is 10. So just looking at that, we know we need 9,000 units to sell just to break even. So we see 9,000 units at $25 gives us our sales of $225,000, less our variable costs give us our contribution margin. But let's look at how another way to look at this. break-even sales dollars are our fixed cost divided by our contribution margin ratio. This ratio, contribution margin of 10 divided by the unit selling price of 25, gives us a contribution margin ratio of 40%. So basically it tells us our fixed cost of $90,000 divided by that contribution margin ratio means we need to make sales of $225,000 just to break even. That break-even point gets affected by changes in the fixed costs and in the unit selling price. So fixed costs do not change in total with changes in the level of activity, but can change because of other factors like possibly advertising, property taxes, supervisor salaries. Assume Bishop Company is evaluating a proposal to budget an additional $100,000 for advertising. So here you see that the unit selling price is 90. They're proposing it to stay at 90. The variable cost is 70. And that unit contribution is at 20. The current fixed costs are at $600,000, but they're wanting to add an extra $100,000 for selling, for potential advertising. Bishop's break-even point before any additional advertising is at 30,000 units. The $600,000 divided by $20 per unit contribution margin. The break-even point after any additional advertising is going to be 35,000 units. Now it's 700,000 fixed costs divided by 20. That $100,000 increase requires an additional 5,000 units of sales to break even. Changes in fixed cost affect the break-even point as shown. As we increase fixed costs, we then increase the break-even point. When we decrease our fixed costs, then we decrease the break-even point. Unit variable costs don't change with changes in the level of activity, but variable costs may be affected by changes in the cost per unit of the direct materials or the wage rate for direct labor or the sales commissions we pay to salespeople. So if we assume Park Company is evaluating a proposal to pay an additional 2% of commissions on sales to its salespeople, then you see our unit variable cost is we're proposing that to increase, which then lowers our unit contribution margin. So in this case, our fixed costs have not changed, but our variable costs have changed. So Park's break-even point before that additional 2% commission is 8,000 units. But if we add that 2% commission, costs are going to go up $5 per unit. This increase in the unit variable cost is going to reduce our contribution margin down to $100. So the break-even point after the additional 2% commission goes from 8,000 units now to 8,400 units. An additional 400 units need to be required to break even. In this case, changes in unit variable costs will affect the break even. Increase in unit variable costs increase the break even point. Decreases in unit variable costs decrease the break even. As shown here for Graham, the price increase of $10 increased the unit contribution margin by $10, which decreased the break-even point by 10,000 units, from 30,000 units down 20,000 units. Changes in the unit selling price affect the break-even point. Increases in the unit selling price decrease the break-even. Decreases in the unit selling price increase the break-even. So the break-even point in sales changes in the same direction as changes in the variable costs per unit and fixed costs. Also, the break-even point in sales changes in the opposite direction as changes in the unit selling price. These changes on the break-even point in sales are shown here, with fixed costs as changes increase, our effective change in break-even sales increase, and the opposite is true. With unit variable costs, the increase in variable costs increase our break-even. The unit selling price, as the unit selling price increases, the break-even and sales decrease. When we look at break-even, the equation, and modifying it, the sales required to earn a target or desired amount can be looked at by the units of sales equal the fixed cost plus our target profit, divide that by our unit contribution margin. So we have Waltham, we have our fixed cost with our 200,000, our target profit of 100. We've got the unit selling price minus the variable cost, give us our contribution margin of $30. So if we take our fixed cost plus our profit of 300,000, divide that by our contribution margin, we need to sell 10,000 units to meet those needs. As you see in the income statement for Waltham, sales of 750,000, which is the 10,000 units times $75, are necessary in order to earn the target profit of 100,000. Kathy's confectionery has fixed cost of 78,000 and would like to earn a target profit of 90,000. Its product sells for $15 and has a unit variable cost of $12. How many units of the product must be sold to attain the target profit? Do you see, if we take the 78,000 plus our profit of 90,000, divide that by our contribution margin of 3, we see we need to sell 56,000 units. Here, we can graph this. A cost volume profit chart, which we call a break-even chart, shows the sales and the cost and the profit or loss for various levels that we're going to sell. So we're going to look at Munoz with fixed cost of 100,000, unit selling of 50, unit variable of 30, and then a unit contribution margin of 20. So we're going to take the volume in units of sales along the horizontal axis, and the dollar amounts are going to be on the vertical axis. Then a total sales line we plot by connecting the points, and a total cost line is plotted by beginning with fixed costs on the vertical axis. We'll find that second point by multiplying the maximum number of units in the relevant range, way over to the right of the horizontal axis by the unit variable cost, and then adding those fixed costs, and then find the break-even point. So you see here the break-even point for Munoz is 250,000 of sales. We show this by 5,000 units. Operating profits will be earned when sales levels are to the right of the break-even point, which gives us operating profit. Operating losses are going to happen when sales are to the left of the break-even point. Changes in the unit selling price, the total fixed cost, and unit variable costs all get analyzed using this chart. Using the data in that previous slide, let's assume Munoz is evaluating a proposal to reduce fixed costs then by $20,000. So the total fixed cost would be then $80,000. As we'll look in the upcoming slide, the total cost line gets redrawn, starting at $80,000 on the vertical axis. And then the second point is determined by multiplying the maximum number of units in the relevant range, way on that horizontal axis by the unit variable cost, and adding the fixed costs. Here, the total estimated cost for 10,000 units is the $380,000, 10,000 units at $30 plus our $80,000. The cost line is drawn upward to the right from $80,000 on the vertical axis through the $380,000 point. The profit volume chart plots only the difference between total sales and total costs. The profit volume chart allows managers to determine the operating profit or loss for various levels of units sold. So for Munoz, we've got our fixed cost and we've got our contribution margin of $20. The maximum operating profit is $100,000 here. By 10,000 units at $50, our variable costs that provide us with our contribution margin of $200,000. We've got our fixed cost and then our operating profit here of $100,000. The profit volume chart will figure in 5 steps. Our volume in sales goes on the horizontal axis. Dollar amounts showing profits and losses are on the vertical axis. And then a point that represents the maximum operating loss gets plotted on the vertical axis to the left, and a loss equal to the total fixed cost at the 0 level of sales. Then a point representing the maximum operating profit is plotted on the right, the diagonal profit line is drawn, and the profit line intersects. So as you see here, the break-even point for Munoz is 5,000 units of sales, which is total sales of $250,000, 5,000 units at $50. Operating profit will be earned when sales levels are to the right of the break-even point. Losses are going to happen when they're to the left of the break-even point. So at sales of 8,000 units, an operating profit of $60,000 will be earned, as you see here. Changes in the unit selling price, total fixed cost, and unit variable cost on profit can be analyzed using this profit volume chart. We can look and go, consider the effect of a 20,000 increase in fixed costs and how we can have a profit. At the maximum sales of 10,000 units, the maximum operating profit would be 80,000 units. So as you see here, the original and the revised profit volume charts for Munoz are shown here. The revised profit volume chart indicates that the break-even point for Munoz is 6,000 units of sales. This is the 300,000, the 6,000 units at 50. The operating loss area of the chart has increased while the operating profit area has decreased. These assumptions really simplify cost, volume, profit analysis. Because they're often valid for the relevant range of operations, cost, volume, profit analysis is very helpful for decision making. Many companies sell more than just one product at a different selling price. Break even can be used by considering sales mixes. That sales mix is really a relative distribution of sales among the products sold by a company. Here we've got Cengage Company that has two different products that are being sold. They've got product A, they've got product B, and they have the selling price of each of the products. So the total fixed costs are $200,000. And based on what's being sold by each product, as you see here, in this case, the product mix is 80% to product A and 20% to product B. So they have a sales mix, and they can express it as a percentage of total units sold. 10,000 units, 8,000 for product A, 2,000 for product B, were sold during the year. So the sales mix is 80%, 8,000 divided by 10,000 units for product A and 20% for product B. This mix gets labeled, and the unit selling price of M equals the sum of all the unit selling prices of each product multiplied by its sales mix percent. So as you see here, based on this mix, our unit contribution margin of our mix is at $25. If the total fixed cost are $200,000, then we need to sell this mix of 8,000 units. Since that mix is 80% of product A and 20% of product B, then we know we need to sell 6,400 units of product A and 1,600 units of product B. So as you see here, this shows how you can calculate the break-even point for this mix. Operating leverage is the relationship between the contribution margin and operating income. Literally, operating leverage is the contribution margin, divide that by operating income. The difference between contribution margin and operating income are the fixed costs. So companies with a high fixed cost are going to have a high operating leverage. Here we've got two companies, Jones and Wilson. You see, Jones has a higher fixed cost. They have the same sales, the same variable costs, and the same contribution margin, but Jones has larger fixed cost, which will result in a higher operating leverage. Do you see the 100 divided by 20, 100,000 divided by 20,000 is a leverage of 5, where Wilson just has a operating leverage of 2. Operating leverage can be used to measure the impact of changes in sales on operating income. So in this case, if the sales increase by 10% or by 40,000 for both Jones and Wilson, the percent of change in operating income is going to equal the percent change of sales, 10%, times the operating leverage of 5%, which is 50% change of operating income. Now, Wilson's is the percent change of operating income is the percent change in sales, 10% times the operating leverage of 2%. So you see here, Jones, operating income increases by 50%, while Wilson's only increased by 20% because Wilson didn't have those fixed costs. The impact of a change in sales on operating income for companies with high and low operating leverage is shown here on the slide. The margin of safety indicates the decrease in sales that may occur before an operating loss results. The current sales may decline 50,000, which is 2,000 units or 20% before an operating loss occurs. If the margin of safety is low, even a small decline in sales can result in an operating loss. Whitman Industries has sales of $800,000 at the end of the year. Its break-even point for sales was $680,000. What is the margin of safety expressed as a percentage of sales? 15% there. Break-even analysis for a service company involves identifying the correct unit of analysis and the correct measure of activity for that unit. If we take a look at this, we see, consider the break-even number of students for a non-credit course in pottery with a $500 tuition. If we look at our variable costs per student and then our fixed costs, we take our fixed costs, divide that by our contribution margin to show $4,500 minus the contribution margin of $180 shows we need 25 students just to break even. Well, guys, there you have it. I hope this has been helpful, and I hope you have a great week.